Joining us now in the markets, Cameron Dawson. She's the Chief Investment Officer for NewEdge Wealth. Cameron, you have been taking Jay Powell at his word, I think, for a while, and as a result, didn't feel, I don't know, too enamored of going in now into stocks or equities. After what happened and the idea that maybe it causes the Fed to pause, or maybe it's done some of the work for the Fed, are you feeling better about the prospects for the stock market, or even worse?
Well, it all depends on the path of earnings, because just because the Fed cuts rates or starts to ease policy, if you don't see downside to earnings estimates, that would be very, very bullish for risk assets, similar to what we saw in 2016 as well as 2019, where the Fed started to ease policy, but we didn't have an earnings recession, so stocks did great. Now, if we do have an earnings recession, that's where Fed cutting rates isn't actually bullish for risk assets yet. So what we have to watch is those estimates being revised lower with higher risk of recession in the wake of what's going on with regional banks. And we think one of the reasons why markets have been so resilient over the last few weeks is that you haven't seen cuts to estimates yet. Now, that may reflect certainty or uncertainty about what the ultimate impact of these regional banking issues will have on the overall economy.
The BlackRock the stance that company is taking. If earnings are definitely, if estimates are too high, and we're definitely going to see some credit contraction, and we'll see, that a lot of the things the Fed has already done, we see they start taking a bite out of growth. Is that the right move for the Fed to just stay in this? Do you think they go another 25 and then 25 after that? Do you think that's the right move for the Fed, or do you think that they've been chastened maybe by what happened?
Well, we do think that the ultimate impact of banking issues will affect the credit channel, as you said, and that if you see loan growth roll over, that's typically consistent with the fact that you're going into a recession. The problem with that is that it is very lagging and it tends to move slowly. So if we think about the May meeting coming up, they'll only have March data to consider at that May meeting because the April data comes after they meet. And so if you see continued strength within the March data, which won't reflect any of this rolling over in loan growth, then the reality could be that May is still a very much a live meeting because they are still very much in this inflation fighting mode, as we heard from Powell last week, and as we'll likely hear from Fed speakers all this week.
And nothing has changed. What's the ultimate lows? Are the lows in for the S&P for 2023?
We think that a retest of the October low or the December low, it really depends on the path of earnings estimates. If we do see earnings estimates get cut, if we start to see a rising risk of recession, then the lows aren't in. But if the economy hangs in there, we don't see loan growth absolutely fall off a cliff, then the fact that we went down to about 3,800, those December lows might hold. But then on the upside, we see a lot of challenge getting up above 4,100 simply because you're trading at nearly 19 times when you're at 4,100. And even a Fed pause or a slight pivot to interest rate cuts wouldn't really suggest going all the way into those pandemic level bubble territory multiples above 19 times. So we're really looking at a range bound scenario at best for markets, probably for the remainder of 23.